Investing for impact has been growing. That includes so-called ESG investing, that is, considering the ethical impact of a company on the environment, social issues, and corporate governance. Our next guest is here to talk about what's behind this trend and why investors perhaps should be a bit cautious. Vikram Gandhi is founder and CEO at VSG Capital Advisors and a senior lecturer at Harvard Business School. Welcome.
Thank you. Thank you very much.
So what started out as a little bit of a sideline to asset management, considering social impact and things like that, has obviously gone very mainstream. Yeah. There was a time when it was effectively a sense of, well, you know, investors didn't want to participate in certain products or trends. Now there's been this revisionist idea that, in fact, it's actually good for investment performance as well somehow. Where do you come down on that, and where's this industry?
Yeah, so I think there's a whole spectrum of approaches here, and I kind of divide it between values and value. So the three trends that are really driving this, like you say, it was kind of a peripheral thing, and now it's become much more mainstream. The three things are, one is that whether you like it or not, the millennials are going to control a lot of the assets, and any survey that suggests that is taken suggests that millennials, 23 to 39-year-olds, are significantly more sensitive to these issues, and it's more important for them. And there's going to be about a $40 trillion of assets transferred to them in the next 2 decades. So that's one. The second is that as the world kind of coalesces around certain important issues, say, for example, the UN Sustainable Goals, it is clear that the requirement to kind of get where we need to get to, of $5 to $7 trillion a year, is just not going to get there by government spending and philanthropy. So private capital has to play a role in that. And I think the third, as you rightfully just said, is that there's growing evidence, and we've done a lot of research at HBS on this, some of my colleagues have, growing research that companies that actually focus on ESG issues that are important to their business outperform. In fact, there's a study we did over 1992 to 2012, over 30 years, 48 industries, a whole bunch of sectors, and there was consistently a 6% alpha on companies that actually focused on, and it's important to mention materiality. You know, you go to the Bloomberg terminal, there are 300 ESG issues. But ESG issues for a tech company are very different for a consumer company, to a service company, to an energy company. So it's kind of an obvious thing if you step back, because it says, well, companies that focus on things that are important for their business should do better. But it's not really happened to now. So from an investor perspective, there's a realization that this actually is really important stuff. And while you do your investment analysis, factoring that in is critical.
The cynical response is that, well, this just creates an overlay of inefficiency, right? You're investing on a premise, something besides, you know, potential returns down the road or financial capabilities.
Yeah. There's some of that. That's why I distinguish between values and value. And the values are there. I mean, you know, certain religious organizations will not invest in certain stocks. Some of the California pension plans will not invest in tobacco, et cetera, et cetera. But I think and there's tons of studies been done on this too, and unfortunately, for every study that says you don't lose return, there's another one that says you do, and then you do a meta study that says it's inconclusive.
Right.
But the fact of the matter is that there's been no conclusive evidence which suggests that you're actually losing returns. Okay, well, that's one. Two is that when large pension plans start to look at these things, there's always a debate internally of divestment versus engagement. And that's another very interesting one. I'll give you an example of CalSTRS, that Chris Ailman's been on this show quite a few times. Essentially, when the whole issue of gun violence cropped up, there was a lot of push on the part, I believe, on the part of their pensioners to divest gun stocks. And they could have done that, but they chose, in fact, to own the gun stocks and be more proactive, brought another whole bunch of institutional investors together. In fact, we hosted them at HBS for that, basically saying, look, you guys are in the business of manufacturing guns. We can't stop you from doing that. But here are the 6 things you can do to be more responsible as a civilian gun manufacturer. And they came out with those principles. And we'll see, I think, see a lot of that in the proxy season this year. So I think there is this issue of inefficiency to some extent. But I do think that a lot of firms, a lot of investors are now moving towards the engagement kind of approach. And I think you're going to see that in the proxy season. Climate is the #1 issue. Yeah. Really focusing companies to really both disclose information, like I did with Shell and with BP and others, tying incentive compensation to those issues. So I think this is here to stay, and the assets under management are growing. And I would think that in 10 years, there won't be this separate kind of ESG discussion. It'll just be part of it.
Yeah, to your point, I mean, what is going to happen to the asset management industry? Is it going to mean the ESG fund managers and the pure plays are going to grow exponentially, or is it more, in fact, just that traditional fund managers adapt the way they do their business?
I would think it's more the latter than the former, because I do think, again, you get into this issue of long-term versus short-term investing and the quarterly earnings versus long-term. And I think if you look at the pension plans, you look at this growing trend towards passive investing, these companies, these investors have to own these stocks. And so for them not to actually focus on these issues as long-term investors will actually result in poor investment decisions.
The same logic, I think, though, doesn't it lead all CEOs and boards of public companies to say, hey, we are an ESG-compatible institution here?
Absolutely. So I do think that trend is going to come. I mean,
But then you have to pick and choose among those that are truly so.
Well, you think about, without ESG, forget ESG, you pick and choose companies which are performing better financially and which are not. And I think that ESG will just be part of that process.
How is technology judged by ESG firms? Say you look at the explosive growth in tech, how it's going to dominate our lives for the years forward. Social media, there's positives and negatives. How do funds judge all of that?
Well, I think so if you look at just the pure ESG factors in that context, in fact, we wrote a case, it was a case on gender diversity. State Street launched this in the ETF, it's traded on the NYSE, and the idea was that companies which have more diverse boards and senior management would get higher weightings in this ETF. And not because it was a values thing. I mean, again, there are tons of studies which show that men and women think differently, and you put them together in a room, they make better decisions. And once they did the weightings, they realized that the tech companies and the energy companies would be seriously underweight in that index. And so they had to, because ultimately, and CalSTRS actually had sponsored this ETF, they had to have some sort of tracking to the index, so they had to make some adjustments. But I think the tech companies, as far as governance issues go, I think there's a lot of room to go, both in terms of diversity, in terms of shareholder involvement, the dual voting shares, et cetera. So I would say on the one hand, they've obviously done phenomenally well for this world, and we wouldn't be doing a lot of things if it weren't for them. But I do think they can improve on a lot of ESG front.
I'm even thinking like our disruptive technologies.
The societal impact.
Yeah, the societal impact of some of the products is what I'm thinking as well.
Yeah.